I just reminded myself to hit the record button there. So I'd now like to welcome back Doug Carroll, who's no stranger to us. However, I'll formally introduce him for those that are joining us for the first time. Doug Carroll is the tax and estate specialist for Aviso Wealth, a wealth management partner to many credit unions across Canada. He previously ran an estate planning law practice and was an advanced case consultant with a life insurer and a mutual fund provider. Doug also holds a business degree and a Master of Law specializing in tax. Doug is qualified as a certified financial planner and as a trust and estate practitioner. He's been doing this for 25 plus years now, supporting our financial advisors from written articles to individual case consultations, and of course, webcasts such as the one that we are doing today. So without any further ado, I'll hand it over to you.
Okay, I'm going to bring up my screen here. And if you want to give me the thumbs up that you can see it, if you can see it, then everyone should be able to see that. Okay, so I'm going to get into the content just straight away. I'm not going to waste any time here because there is a lot of detail that I'm going to get into. And for everyone's comfort level, and this is true of all the sessions that we're doing, there's written material that supports the content that we're presenting here. In this case, it's a bulletin that's about 8 or 9 pages long that it runs the exact same route as the headings and the sub bullets that we have in here. And there are a lot of points. I've got it down as 22 for 2022, but there's actually more than 22. I just needed to have something that's got some cachet to it. You can call it that for year-end tax planning. And those things that I might skip over just for the sake of the time that we have here are in the written material. And if there are any things that you don't catch as you're perhaps taking some notes, then again, you can refer to the written material and it'll have dollar figures that I might make reference to, or any of the points that I say that I'm going to skip forward on. So let me get right into it. I will keep an eye on the time because we want to allow for questions that you may have as we get towards the end of the session here. And so I will be conscious of that as we're going through here. And Michael will stop me if there's something absolutely critical that someone is asking, and then otherwise he'll keep an eye on that Q&A box, and we'll discuss those things once we get to the end. So as a starting point on savings and retirement, and much more so on the retirement aspect of things, you can make your RSP contributions during the course of the year, or you can make them in the first 60 days of the following year and then get a deduction when you file your taxes for the current year. Even though you can do that in that first 60 days of, in this case, 2023, and then use the contributions for a deduction against your 2022 income, if you can get yourself into the habit of making your contributions to your RSPs on a periodic basis during the year, then you're going to get tax sheltering working for you sooner. If you started at the beginning of 2022 and you put the money in over the course of that year, rather than waiting until the beginning of 2023, then effectively you're getting 12 to 14 months earlier tax sheltering working for you. So that's something to think about. And I'll come back to that first 60 days on some of the other comments that I have to make here. Now, there are two other programs related to the core RSP being Registered Retirement Savings Plan. And I appreciate that most of the people here would know that phrasing, but I really do want to emphasize that the second R in RSP is retirement. Even though you can use these programs to get early access to the funds that you've set aside for retirement savings, don't lose sight of the fact that that money is for your retirement. That said, if you are a first-time homeowner coming up, or if you are looking at going back to school for some continuing education, then you may be able to access, as in draw out some of the money in your RSP and not be taxable on those amounts in the year that you take those out, as long as they are devoted to the appropriate purpose, whether it's, again, first-time home buyer or a qualifying education program. The thing to understand about both of these programs, and I won't get into the specific numbers of years, but in both cases, there is a clock that starts running from the time that you take a withdrawal that you must begin returning the money to your RSP within a certain number of years. So as we're looking at year end right now, if you take withdrawals from your RSP for either of these purposes before we hit year end, then that clock starts running at any particular year. But if you wait until January, then you push over into 2023. So you have one more year until that clock starts running. You may or may not have flexibility to do that, depending on what your obligations are in paying for these things. But if you do have that kind of flexibility, then it's helpful to you, to give you a little bit less stress to your finances if you can push it out a further year. Understand as well, and I'm not getting into the details of either of these programs here, understand as well, if you do not pay the money back into your RSP when you've withdrawn for either of these two programs, then the non-repayment is brought into your income in that later year, and you'll have to pay tax on that amount in that later year if you do not pay that money back into your RSP. And since you already used that money for, respectively, a new home purchase or for an additional upgrade on your education, then you might be scrambling for cash at that later time. So just make sure that you understand how the programs work, and that you can give yourself a little bit less stress if you were to be able to start your withdrawals just 1 year later, going into 2023 in this case. Next item that I have here is about the age 65. The availability of what's called the pension tax credit. The pension tax credit applies on withdrawals from registered retirement savings. Specifically, it's for pension income or for payments out of a RIF, a registered retirement income fund, or a registered annuity. An RSP is an accumulating vehicle, and then once you get out to no later than age 71, which is my next point, no later than December 31st, the year that you turn age 71, then you either have to take the RSP money into income, or as a combination, or purchase an annuity that then pays out an amount for a set period of time, perhaps for life, or number three would be to transfer the money from the RSP over into a RIF. Then the RIF then continues to be tax sheltered, and there is a minimum withdrawal that has to come out of the RIF. So once you hit age 65, when you take a pension income amount that's paid to you from a registered pension plan, or a RIF payment or a registered annuity payment, those amounts qualify for the pension credit. Now, the pension credit is the first $2,000 that you have coming out of that plan, and it allows you to take a tax break of somewhere $350 or so, depends on province. You've got your federal amount and your provincial amount that associates with that. So if you are 65 and you're not yet drawing down off of those tax sheltered retirement savings, then talk to your financial advisor about taking some of your money, at the very least, taking some of your money so that you can make use of this pension tax credit once you are 65, because it does not carry forward. If you don't use it in a year, you can't claim it in a later year looking back at a preceding year. So you got to use it once you hit age 65. You've got the access and the availability of it. So talk to your financial advisor about putting yourself in position to claim that credit. Now, I already mentioned about the age 71 issue with retirement savings, that you have to take the money from the RSP and either cash out, RIF, or purchase a registered annuity. So be aware of that as we're closing in on year end. If you turn 71 this year, then you need to do that before we hit the end of the year. And after we get past the end of this year, you can't hold an RSP any longer. You also can't make contributions into RSPs once you are past age 71. But if your spouse is under that age requirement, then you may be able to make contributions into a spousal RSP. So that could affect your cash management on your retirement savings, both in terms of having to move the money that exists in RSP, as well as the potential for making contributions in a different way than may have been in the past when you were under 71. So again, if you turn 71 this year in 2022, then you need to convert that RSP before we hit December 31st. The last item I have here is about tax-free savings accounts, which don't have the same kinds of age constraints associated with them, and you can use TFSAs for whichever purpose you would like. You don't have any requirement that you take those amounts out from a tax-free savings account. The benefit of, or one of the benefits of tax-free savings account is that the TFSA, although you don't get a tax deduction when you put the money in, like with RSPs and RIFs, you get tax sheltered growth happening inside the plan. And then when you draw the money out with the TFSA, there is no tax that applies on the withdrawal of money on the TFSA. So as we are closing in on year end, for your knowledge, the TFSA room that's available to people who are at least age 18 and Canadian residents has been $6,000 for, I think, 4 years now, and it will go up to $6,500 when we come up to January the 1st. By the way, the increase to $6,500, it happens every few years based on an indexing formula that rounds out to the nearest $500 level. Because inflation was so high this year, not only do we go from $6,000 to $6,500, but if we have a fairly high rate of inflation next year, somewhere around 3%, if that's where we're at, not hoping for it, but if that's the case, then we may see in 2024 the next level of increase up to $7,000 of annual room. So for the current purposes, come January 1st, the annual TFSA room will be $6,500. Okay, turning now to talk specifically about spouses and spousal RSPs, so spousal savings. Between spouses, the most common way that you're going to reduce taxes in a household is to try to shift income to other family members who are in a lower tax bracket. And most often, that's really about how to manage things between the spouses who are involved. Spousal RSP is one of the most common ways that you can do this. It's not going to change the tax rate on income on a current year basis, but it allows for tax reduction out there into your later years, whether you're actually in retirement, as in the time that you are no longer working, or if it is just further out in time. With spousal RSPs, you can use your own room for RSPs to go into your own RSP or into a spouse's RSP. When you put it into the spouse's RSP, that spouse owns that plan. That spouse is the annuitant on the plan. And when he or she draws the money out, that's the person who is taxed on it, except if the withdrawal happens in the year of contribution or either of the next 2 calendar years. Sometimes what people might do as they're nearing retirement age, and perhaps even sooner if they are aware of how the rules work and they're not going to put their retirement at risk, there may be a plan to make withdrawals sooner than waiting until completely being non-working, both spouses being non-working. So one of the things to be aware of is that 3-year limitation on taking the withdrawals. If you are in that position where you are a high and low income spouse, and the low income spouse, as the annuitant on the spousal RSP, will be making, or you are considering will be making, a withdrawal from the plan, then better to make the contribution into that RSP before December 31st this year, because the 3-year time period would be this year, 2022, 23, and 24. And then withdrawals can come out into that spousal, the spousal annuitant's hands in 2025. But if you wait until the first 60 days of the coming year, then the physical contribution is made in 2023, even though you might use it to reduce your 2022 income when you file your taxes and take a deduction. So the contribution is in 2023, the next 2 years are 2024 and 25. You have to wait an extra year till 2026 to take the withdrawal and not have attribution back to the contributor spouse on that spousal RSP. Now, I've got the next point here, again, talking a little bit about tax-free savings account. Tax-free savings accounts are not subject to the attribution like there is with spousal RSPs. you can give money to a spouse, and then he or she can put it into his or her own tax-free savings account, TFSA. So as you're looking at how you possibly can reduce down the taxes in the household or facilitate for the later reduction of taxes, then the coordination of these two types of plans are not the only places, but the coordination of these two types of plans will be something that you'll want to think about, and possibly have some money that goes into spousal RSP and maybe some money that's given to the other spouse, that the other spouse will then put into his or her own TFSA. Next point about prescribed rate loans is referring to, or is related to, non-registered money. So these preceding ones I just talked about were about tax sheltered money under the Income Tax Act, where you give money to a spouse and he or she then invests that money and earns investment income. The income is attributable back to the giver spouse. And that's something that you would like to be able to just give to your lower income spouse and have the investment income in his or her hands, but it's just not that easy. So one of the things that you can do to work around that is to have the otherwise gift structured as a loan from the high income spouse to the low income spouse, and then the low income spouse must pay interest on that, and having paid that interest, then the investment income will be taxed to that lower income spouse. The prescribed aspect of this is that there are regulations that state what minimum interest rate must apply on that loan between these two spouses. And the lower the interest rate, the better the deal is between the two of them, because it is a deduction to the borrowing spouse when the interest is paid, but it's an income inclusion to the lending spouse. The rate has been at 1% for much of the last 14, 15 years. Let's see, since 2009. It's gone up to 2%. It's in integers only. It doesn't go up in basis points. It's been at 1% for most of the time since 2009, but over the course of this last year, it's gone up fairly significantly. It stands right now at 3%, and it will go to 4% come January the 1st. It's less of a deal the higher the interest rate is. It might not make a ton of sense anymore for spouses unless you truly have a very wide gap between the two, high and low income. If you're in that category, though, then have a conversation with your financial advisor and your tax advisor whether it's worth doing. If you can get it done before the end of this year, then the interest rate in the quarter when you set it up will be able to continue to be the rate for the life of the loan. And as I said, come January the 1st, the rate goes from 3% as it is right now to 4%. So some speed in getting this put in place would be important. For children's education, moving off the spouses now, one of the main ways that we save for our children, apart from general savings, is to provide for their education. And the Registered Education Savings Plan, the RESP, is a core type of savings that we use. With RESPs, you have the benefit that there is tax sheltering on your contributions into the plan that then ends up on the growth being taxed to the child when that child goes to school as a student. The growth in the money is taxed then. The other benefit, apart from the tax sheltering, is that the government, the core program for supporting RESPs, the Canada Education Savings Grant, it allows for matching grants to be contributed into the plan based on you contributing money into the plan. So they truly are matching. The government adds in a 20% matching grant as the main part of the Canada Education Savings Grant program. And so you want to be able to use the government's money for that purpose, but there are limits to how much you can receive on that plan on a per year basis. The main limit is $500 per year, the matching grant is 20%, which means that if you put in $2,500, the government will put in $500 to your plan, and then all of the money is tax sheltered. There's some carry forward rules if you don't use the plan, but the carry forward rules are limited. So if you are in a position where you have children, and I'll just give you a round number, there's a few different levels or ages where you can be strategic about how you continue to contribute and get the government's money in those through those grants. But if you've got a child who is approaching 10 years of age and you have not yet put money into an RSP, you really do need to take a close look at the rules so that you can get as much and hopefully all of the lifetime availability of the Canada Education Savings Grant, which is $7,200 of matching grants. The last item that I have here is on the other side of education. If you are a person or if you have someone in the family who has been a student and has used government supported loans, then the interest on those loans is deductible to that person. Unfortunately, well, not unfortunately, but practically, for a lot of students who are just shortly out of school, they may not have sufficient income to take a deduction for the interest payments. And so there is a 5-year carry forward on interest payments that you don't use as a student when you are paying back those loans subsequent to your education time. The 5-year carry forward means that for interest payments that were made in 2016, this year, 2022, is the last year that there can be a deduction taken on those past interest payments. So if you have somebody in the family who has been paying down those type of loans, then they should take a close look at their balances and when they paid the interest, and if possible, then try to take the deduction now. Otherwise, it might fall off the book, so to speak, and will not be available as a deduction out there in the future. All right, I'm going to switch over from the people in the house, talk about the house itself, and particularly talking about buying a new house. And I already made mention about the home buyers plan. That's the RSP support adjunct program, which allows for you to take money out of your RSP for buying a new home. But we now have a new program which was introduced in the election campaign a year ago, and then in the federal budget earlier this year, which is the First Home Savings Account. This type of program, the way that it operates, is that it as portrayed in the way that the election campaign, particularly, it has features of RSPs and tax-free savings accounts that you are able to work with in making use of this FHSA. And what I mean by that, or what the government meant by that, is that when you make contributions into an FHSA, they are tax deductible. And then when you use the money, which will grow tax shelter from that plan, when you use it for a first-time home purchase, there is no taxation on the withdrawal of those amounts. So tax deductible like RSPs, non-taxation of withdrawals like TFSAs. So it's got some interesting new features associated with it. The maximum per year contribution into the FHSA is $8,000, and the lifetime maximum will be or is $40,000. Just recently, there was some clarification on the rules that the contributions into the plan will be available to be made. You can make use of them as of April the 1st, 2023. And the early framing of this was that if you use the FHSA, then you can't use the RSP home buyers plan, and vice versa, just one or the other. But the government has switched up on that and said, yeah, you can now use the both the FHSA and the home buyers plan for the purchase of the same new home, as long as you qualify as a new home buyer, and the definitions are the same as a new home buyer for those two programs. The last item here that I've got under this down payment is large TFSA withdrawals. You can use TFSA money for anything that you want. You don't have any kind of restrictions that it must be used for home purchase. But since it came into existence, since 2009, the TFSA came into existence, it has been a useful place that quite a few people will have used to accumulate money towards their savings for a home purchase. So now we have got at least 2 specifically targeted programs, plus the TFSA, that can be used for making a new home purchase. If the TFSA is one of those things that you're using, and this might be unlikely, but if you want to be able to use it and then use TFSA room in future very soon, then one of the rules with TFSAs is every dollar that you take out of a TFSA, you get a credit for a recontribution as of the next January the 1st. So whether or not we're talking about buying a new house, if you're going to make a large purchase from accumulated money that's currently in your TFSA, if you take that money out now, or as in before the end of the year, then you'll be able to get your credit for recontribution in 2023 as of January the 1st. But if you wait to take the withdrawal for this large purchase, again, home or not, until after we cross the new year, then you won't get that credit until January 2024. So that may not be applicable if you're making a really large purchase and you don't have a lot of excess cash thereafter, but it could be the case that you want to be able to recontribute, and getting that money out then before December 31st would be an important consideration. Expenses when working from home and using a home office or home space. We had the introduction of the streamlined way that people could claim home expenses for work. That was introduced back in 2020 when the pandemic began. $2 per day that you were working from home due to COVID-19. Originally, it was no more than 200 days that would apply. And then it was lifted up to 250 days, which is where it stands right now. The $2 amount times the potential 250 days that you might be working gives you a potential deduction of $500 that's available. But depending on your situation, it might be more effective to make a claim using the detailed method. So that's the streamlined method, where you don't have to provide pretty much any records other than the statement that you are required to work from home, and so you're claiming the $2 per day. But if you want to do the detailed method, you'll need more information to be reported, and you may need some further support from your employer. So possibly importantly, you'll want to make sure that you get that together, and this might be a good time to check with your employer on that, collect up the documents and anything that's supporting that, so you have it ready to go, rather than to be scrambling when you come up to tax filing time once we get into the new year. The last grouping of topics here about relocating within Canada. There are some significant tax reductions that might be available to you if you have moved, particularly if you've gone from province to province. The tax that applies on a provincial basis is based on where you are resident on December 31st of the year. So it's not a proportionate thing. If you move during the course of the year, if you're 6 months in one province and 6 months in another, you don't pay your provincial portion of tax. You pay federal wherever you might be, but you don't pay your provincial portion of tax proportionate to how much time you spent in the year. You just pay based on where you were on December the 31st. So if you have some flexibility, if you are moving, if you're in the midst of it, and you have some flexibility about this, then make sure that you have an understanding of what the tax rates are for your originating province and then your target province. And if you have one that is reasonably higher tax than the other one, then you might want to look at either accelerating the move or deferring the move a bit to get before or after December 31st, again, based on being in the lower taxed province on December 31st. Moving expenses generally can be deductible if you are moving at least 40 kilometers closer to work, or you're starting a new business yourself, or if you're going into full-time schooling, then you might be able to deduct some of your moving expenses. So if you are doing that, then if you have those moves that have happened over the course of this year, get those records together. They can be quite significant, including potentially you could have real estate commissions that that are deductible, and that would be a very large amount for just about any home sale, and particularly as real estate prices grew, although they've flattened a bit. It could be a very large deduction that might be available to you there. Last item about the principal residence exemption is more a reminder, which will be a continuing reminder for a while. This is not so much a year-end issue as it is a change in the reporting process that happened, where where you have the sale of a property that you're claiming the principal residence exemption upon. The principal residence exemption allows for you not to be taxed on the capital gain of a principal residence, and up until 2016. There was no particular reporting that was required in order to claim that that exemption. You simply sold the property and you just did not have to report the capital gain associated with it. But since 2016, you do have to report details about the purchase price, the sale price, any changes in ownership, the dates are involved. There's a few details that have to be reported. And then you claim the principal residence exemption on the capital gain associated with it. Because the sale of a home is a fairly infrequent thing, you may be in a position where the last time that you sold a property was prior to 2016, maybe well prior to that, and so this might be new news. The thing that you can do is make sure that you've got your records again ready to file when it comes around to tax filing time. And that means checking with the lawyer's office. If the lawyer's office was particularly busy, again, perhaps less busy this year than in recent years, but if the lawyer's office is particularly busy, they might be slow on reporting out the files that they have. And you want to make sure that you're pushed to the top of the list and you get your file in your hands so that you have the necessary information to be able to fulfill your obligation to do your tax filing, because there are penalties if you are late in making those filings when you are trying to claim the principal residence exemption. Looking now at people who claim the disability tax credit, one of the really helpful supports that we have available that's been around for about 15 years roughly, since just around 2008, is the disability, the registered disability savings plan. And this is a plan which, like the registered education savings plan, the government has both matching grants as well as free bond money that pays into these. And the amount of payments the government makes is in part dependent on the income level of the individuals who are involved. And when I say individuals, what I mean is that if you have a person who claims disability tax credit who is under age of majority, under age 18 actually, then it's the parent's income, the family net income, that determines the amount of either or both of bond money and grant money that's available. But once the disability tax credit eligible person gets to be an adult, then it's that person's own income that applies. So the age aspect, or the year-end aspect of this, is related to the person's own age. That turning from being a minor to age 18 may affect decisions about funding the RDSP, because it would affect the amount of grant and bond money that would be available. And then in terms of opening these plans and the limit to when these are available, you have to open one before the person turns, before December 31st of the year the person turns 59. And that government support money is only available up until December 31st of the year that the person turns age 49. So the years are up here for a reminder. Just if you do have someone in the family, yourself or someone else in the family, who is claiming the disability tax credit and you have not yet either opened or funded an RDSP, then make sure that you get a better understanding of how the rules operate, and make sure that you collect up the money that you're entitled to through the plans. The home accessibility tax credit is a tax credit that's available. It was increased from $10,000 per year to $20,000 per year. And that's not how much you get, but if you spend that much, $20,000 per year, in order to make a property more accessible for a person who claims disability tax credit, and you spend on making it safer, or just a better accommodation for this person related to the disability, then you can claim a disability or a home accessibility tax credit on that. At $20,000, it's worth $3,000 as a credit. It's a federal credit. If you had a larger project that was happening, then you might want to spread the project over the course of more than 1 year, because that $20,000 amount can be claimed in more than 1 year. Every year it's available. So let's simplify the math and just say, well, there's a $40,000 project that you're doing. If you do half of that project before we hit year end and the other half of the project after year end, I know that might be asking a lot given the time of year as we are right now, already in December, but if that is the case, that it can be split up in that way, then you'd be able to claim the home accessibility tax credit in 2022 and in 2023. And based on the numbers that I gave you, it would be $20,000 in 1 year and $20,000 the other year. You would get a $3,000 tax credit 1 year and then another $3,000 tax credit the other year. So as you're looking at what projects might be coming up, not necessarily this year end, then be aware that this credit is pretty significant in helping out with the cost of doing those things. As well, the medical expense tax credit may be claimed on those exact, so double dipping. It allows for double dipping in some cases, that the medical expense tax credit might be claimable on those same expenses that qualify for the home accessibility credit. And then with medical expenses more generally, it's got an interesting feature to it, that rather than being claimed based on expenditures during the calendar year, which is the case for a lot of credits, that it's based on the January 1st to December 31st year. With the medical expense tax credit, you actually get to choose what day of the year will be the end of the year, the 365 days that you want to claim the home accessibility tax, or the medical expense tax credit. With the medical expense tax credit, you have to have a certain amount that you spend, and then over that amount, you get the credit applying. So if you have large expenses, I'll just round it out. It's not exactly, but round about close to $3,000 of medical expenses. Once you get past that $3,000 level, round number, then the credit applies to the overage, the amount beyond. So if you choose a date in the year that captures both some expenses that happened in late 2021 and then also in 2022, then you'll be able to push up past that threshold, because you're able to include both those late 2021 expenses and the early 2022 expenses. So take a look at that in terms of how you have already paid for things, and in future, keep that in mind when you have some flexibility on when you make payments on those types of things. The last item that's here is the multi-generational home renovation tax credit, which is a new one. It's going to be available as of January the 1st. It was introduced in the federal budget. It's similar to the home accessibility tax credit, except that this one is also a tax credit based on how much you spend, up to $50,000 that you spend to create a separate dwelling for someone who claims the disability tax credit. So if you were to do that, have an in-law suite, let's say, that you created for someone who is claiming the disability tax credit, your home is being expanded in order to accommodate that person, then you'll have that credit that can support the construction that might be involved with that renovation. It becomes available, as I say, on January the 1st. So it's not necessarily so much a current year thing to do as a planning matter. But once we come out into next year, it will be available. So if you're in that situation, if that's your family structure, then you can look into that and look forward to being able to make use of that if you're needing to do renovations. A few things now about investors and investing in the markets. The common type of year-end activity that we get into is what's sometimes referred to as tax loss selling or tax loss harvesting, which is making reference to taking transactions where you have an investment which is in a loss position that you decide that you want to realize upon that loss. So when you have capital losses can be applied against capital gains in the current year, or you can carry back to any of the 3 preceding years or forward in time indefinitely. We're talking here about non-registered investments for capital gains to be taxable in the first place, as well as for capital losses then to be available to apply against those capital gains. So the 3-year carryback means that 2019, if you had capital gains in that year, this year in 2022 is the last year that you'll be able to carry back to then apply capital losses you might have this year to reduce capital gains in that earlier year, and if you do that, then to refile the taxes associated with that earlier year. So if you've got something that is an investment you have which is in a loss position currently, then you'll have to have the transaction happen so that the settlement date on the sale happens in 2022. I don't suggest you push it out this far, but it's possible to do that. And the latest possible date is Wednesday, December the 28th. 2 days after that, which is called the settlement date, is the last business day of the year, Friday, December 30th. Do not wait that long. Don't push it to that point, because just on business processes, dealers will have their own limits on when you can do these things. But this is the tax rule that the latest possible date would be the 28th of December. Be careful if you're looking at the particular investment and you'd like to get right back into it, which might be the case. It's in a loss position right now, but you otherwise think that it's going to recover. If you repurchase that within 30 days, either before or after the loss transaction date, then you won't be able to make use of those losses. And that's called the superficial loss rules. I'll refer you to the written document that gets into that in more detail. So be conscious of that. Interest charges on borrowed money and fees that you pay to an advisor for investment advice, those amounts are deductible for non-registered investments, but you have to actually pay them during the course of the calendar year. So you can't just be billed for them. You must make the payments, you must show that you've made the payments if called upon in order to take those deductions. So make sure you've done that before year end. And then the last item here about mutual funds at year end is that when you purchase investments in mutual funds in a non-registered account, there is a point in the year, late in the year, when the mutual fund will distribute out the taxation on its income that it earned over the course of the year. If you buy into a mutual fund late in the year, you may find that you get that distributed taxation, even though you only owned for a short period of time. Have a conversation with your financial advisor about that and how that works. And likely you're going to want to push off and make the purchase early in the coming year. There's a couple more points here before I wrap things up. On business matters, I'm going to assume that most business owners will have an accountant and or a lawyer who they talk to reasonably regularly. So I don't want to go into this in great detail. But if you are a business owner and you are paying dividends to family members who are not actively involved in the business, then you could be subject to the tax on split income, the TOSI rules. And there are different ages that apply and different rules that apply depending on those ages. So once again, take a look at the written document that we have here that we'll be distributing, which will give you some guidance on those issues. if you have family members, children who are about to become adults, or going to cross over from age 24 to 25, or if you yourself are coming up to age 65 and you've got a spouse to whom you're paying dividends, that those can be workarounds for the TOSI rules. If you're going to be acquiring capital assets in a business, accountants will sometimes recommend that you do that late in the year. The tax benefit to doing that rather than doing it early in the year. Talk to your accountant. And then on bonuses before year end, a corporate employer may, if it declares a bonus before year end, it can pay that bonus up to 179 days later. So it gets the deduction in the current year, but you as the employee who receives that don't have to take it into income until it's actually paid, which will be somewhere out there in 2023. And then you don't pay tax on that until you file your taxes in 2024. By April 2024, you pay the tax on that amount. So there's a little bit of deferral that you can get depending on how you set up those bonus payments. Last group of topics here about estate planning and charities. For charitable giving, you have to make donations in order for them to apply to the current year. You have to make those donations before year end. So unlike RSPs where you can make contributions in the first 60 days of the coming year, that doesn't apply with charitable giving. You have to make the donations during the current year. There are lots of carry forward rules with donation tax credits anyway, but if it's critically important that it happens during the course of this year, just be careful, be conscious of that. The other thing is, if you want to be tax friendly about how you're making donations, one of the things that you can do is transfer assets, particularly securities, whether it's individual securities or pooled securities like a mutual fund. You can transfer those in kind to a charity who has a brokerage account who can receive those things. And when you do that, you can then negate the capital gain associated with that. But again, be conscious of doing it such that the settlement of that happens in the current year. Otherwise, it may not give you the benefits in the timing that you want. You might still get the benefits, but not necessarily during the course of this year if this is your intention to get the benefits this year. Registered plan rollovers, just ran into this again just earlier this week in a conversation. If someone dies and the transfer is to a spouse or other qualified beneficiary on a rollover basis, the transfer of that plan must happen by December 31st of the year following the year of death. And when somebody dies, sometimes there are delays for whatever reason before the estate gets administered. And in the case that I was just dealing with this week, the death did happen back in 2021, and they're scrambling now to get the transfer over into the spouse's hands before we hit the end of the year. Otherwise, you don't get the rollover. So if you had a death that occurred in 2021, then make sure that you get that transfer happening before the end of this year. Final point here, and I got one thing to throw in. Final point here is that wills and powers of attorney are part of estate planning. They're core documents for estate planning. This is not necessarily a year-end issue directly, but you do tend to see the people that you care about as we go into the holiday season. And so think about them. Think about whether you've got these things properly in place, and if not, then book an appointment with your lawyer to make sure that you get those things up to date. My very last point, then I'll throw it back to you, Michael. Very last point is that when you get a tax refund, it's quite often because you make a contribution into an RSP that your employer was not aware you were going to make outside of the workplace. And so the withholding tax on your payroll was based on what the employer knew about, and this was something that it maybe did not know about. So if you are going to be making, if you're going to be claiming tax credits that your employer is not aware of, and particularly if you're going to make large contributions to RSPs that will give you a deduction, rather than getting a refund come April, what you might want to do is file this form, the T1213, with your employer, and you disclose what you expect your deductions to be. And then once you have done that, then the employer, as long as everything is copacetic, that it all fits, then your employer will be allowed to reduce down its withholding on your payroll payments so that you'll have more cash flow during the year and not have a refund that you get after year end, which effectively is an interest-free loan to the government. Better that you've got it in your hands than the government has it in its hands. All right, Michael, I'm going to turn it back to you and see what kind of questions came up while I was yammering on there.
Wow, Doug, that was a lot of valuable information, and not surprisingly, we have a number of questions. So I will start with the first one, and this is one that has come up quite often. Is there a limit to the total that can be contributed to TFSA over the years? And for how many years can we contribute to TFSAs? And is there a way to tell how much has been contributed? And is there a penalty for contributing too much?
Yeah, so I'm getting this wrong on the number. I'm going to get it wrong on the number here. But if you don't use your TFSA, then the amounts carry forward. So if you have completely not used your TFSA since it was introduced in 2009, then all of the annual allotment amounts will accumulate for your benefit. It started at $5,000, and then eventually it went up to $5,500, then $6,000, and then again next year it goes up to $6,500 as the available room. It is, I believe, $87,000 might be the carry forward as of right now, if you had never used your TFSA, as long as you were 18 when it was introduced when it started. It was introduced in 2008, but it started in 2009. So that's the available amounts involved with it. I think I missed some of the other points that you mentioned about how it operates.
Is there a penalty for contributing too much?
Oh yeah, there's a penalty. Yeah, if you over contribute, you're taxable on a 1% per month basis on the over contributed amount that you put into it. And so if you think about that, 1% per month, even just on a straight arithmetic basis, even if it wasn't compounding, would be 12% tax that would be annualized on that. So it's a pretty hefty cost if you over contribute. Do not over contribute to your TFSA.
Perfect, thank you. This one I've seen come up a couple of times as well. Are grandparents able to contribute to RESPs, and would they qualify for the 20% grant?
Yeah, so it's the RESP itself that gets the grant based on what is contributed in. It's generally the parents who are going to be the subscribers as the guardians of the children, the subscribers for the RESP. Grandparents can open an account for a child, but they would need permission of the parents in order to do so, because you have to provide the social insurance number to connect it to the child. It could be that the parents open it and then the grandparents provide the money to the parents to go in, or the parents could allow for a direct contribution by the grandparents into the RESP for the benefit of the child, and the grant money then is related to the amount that goes into the plan. One of the unfortunate things, and I've seen this happen a few times, one of the unfortunate thing that happens when you have a marriage breakdown is that you have perhaps two sets of RESPs, the one parent and the other parent, or the grandparents above them. Whoever gets the money in first in the year gets the associated grant money into their particular RESP, which makes some nasty competition that can happen in those situations. Not always, but I've seen it happen where people are competing to get their money in first, so that they get the grant money into their own plan. So that aside, on the general question, can grandparents contribute? Yes, grandparents can contribute.
Perfect, thank you. Next question is, years ago, CRA offered a $100,000 exemption on the income increase for the secondary residence. How can one get paperwork to verify that this is still on file with CRA?
There's a long backstory to that beyond just the 100,000. Back in the 80s, the government of the day introduced a general capital gains exemption, which was to go up as high at the time, as high as 500,000. It was to be implemented over the course of time, and it got up to 100,000, and then there was a change of course on how things were done. Up until that point in time, I believe it was 1994, every individual could claim the principal residence exemption. as of that time, when the changes were made, spouses had to share the principal residence exemption between them. And so what happened is you could make a special election at that time in 1994 to bump up the cost base of a residence by, or a piece of real estate that you treated as a residence, by as much as $100,000 if the fair market value would allow for it to be increased by that much. So it wasn't that it was $100,000 on a second residence; it was that the change was being made that limited the availability of the principal residence exemption to one principal residence per couple. And so as a result of that, people had this availability of making that election to bump that figure up. I would say that the place to go to is look back on your 1994, your 1994 filing, and see what you did to bump up the cost base when you filed your taxes at that point in time, so that you would have an increased tax base on a cost base on a residence and have a reduced capital gain then associated with that particular residence.
Perfect. Thank you, Doug. So the questions are still coming in fast and furious, but I just want to be mindful of time and respect everyone's time. So we'll have time for probably about 2 more. I was wondering if you could expand a bit on the first time, or the FHSA, and a specific question came in. Can FHSA contributions be gifted or transferred to kids or grandchildren?
So now the FHSA, a person can open up an FHSA for themselves. So if you want to give some money to your child or grandchild for that person to put into their own FHSA, then yes, you can do that. Just a little bit more on the dollars. I don't think I said all the dollar amounts associated with it. The per year amount is $8,000. The lifetime contribution amount is $40,000 that can go into the FHSA. And the carry forward on it, you can't do all that $40,000 in a single year. There is some carry forward that's available on it. I don't want to, I know what it is, but I just don't want to mess it up by confusing things. So just be aware that the base level is $8,000 per year. That's only going to be true to do anything with it next year in 2023 anyway. If you don't use it next year, then some of that unused will be able to be used in a later year, but subject to the lifetime $40,000 maximum contribution amount.
Great, thank you. Last question for this session. Can transfer fees paid for moving funds to an RSP be claimed?
Can transfer? I don't want to get into that. That can be quite complicated. I just want to leave that alone. I'll refer you to your financial advisor because there is a straight answer to it. It's just it depends on your circumstances, whether it's something that. When you say claimed, I'm assuming that's claimed as a deduction. I think the bigger issue is whether it is a taxable amount. So just speak with your financial advisor who can get you the answer in your circumstances.
Great, thank you, Doug. So thank you very much again for such valuable information, Doug. And folks on the line, I truly appreciate your time today. If you do have additional questions about today's topic, or if we did not have a chance to address your question, please email us at wealth@alterna.ca, and we will endeavor to get you those answers. Now, a couple of reminders before we do close this session out. First, a survey will be sent out to you shortly. We do look forward to your feedback, as this helps us to continue to provide more engaging topics like this. So please do send us your comments. And secondly, there will be a recording of today's session available soon. And we'll have supplementary information that will be sent out via email as well. So with that being said, I'd like to wish everyone a very happy and safe holiday season. Doug, thank you once again, and thank you everyone on the line for joining us today for our final webinar of 2022. Have a good afternoon.
Thanks, Michael.